Are you in a partnership or thinking of forming one? Then you have probably heard the term guaranteed payments. But do you know how they work? And more importantly, how they are taxed? Today, we are breaking down guaranteed payments, what they are, how the IRS treats them, and the biggest tax mistakes partners make every year. Stick around to the end, and I will share real-world examples and tips to keep more of your partnership income legally. Section 1. What are guaranteed payments? Let's start with the basics. In a partnership, not all income is split based on ownership percentages. Sometimes a partner is promised a fixed payment, no matter how much profit the business makes. That's called a guaranteed payment. Example, you and your partner own a real estate LLC. You agree that your partner will get $3,000 a month for managing the properties, regardless of whether the business is profitable. That's a guaranteed payment. Guaranteed payments are used to compensate partners for services, provide a return on capital invested, create predictable income for active partners. Guaranteed payments are a way for partnerships to ensure certain partners receive steady compensation. Understanding this concept is the first step to making sure your partnership agreement is fair, predictable, and tax compliant. Section 2. How guaranteed payments are taxed? Here is where it gets interesting, and where most people get it wrong. For the partner receiving the payment, guaranteed payments are taxed as ordinary income. They are subject to both income tax and self-employment tax, just like a salary would be. You will see these payments reported on your K-1, Box 4. For the partnership gets to deduct guaranteed payments as a business expense, reducing the partnership's taxable income. But here is the twist. Guaranteed payments are deductible to the partnership even if there is no profit. Example, if your partnership has $100,000 in income and pays $36,000 in guaranteed payments, only $64,000 is left to split among partners. Section 3. Guaranteed payments versus distributive share. Ever think why some partners get paid no matter how the business performs, while others only see income when there is a profit? Let's clear up the confusion between guaranteed payments and profit shares. It is easy to confuse guaranteed payments with a partner's share of profits. Here is the difference. Guaranteed payments. Fixed, paid regardless of profits, taxed as ordinary income, plus self-employment tax. Distributive share. Your percentage of the partnership's profits, taxed as passive income, unless you are a general partner or materially participate. Key tip, guaranteed payments are taxed even if the partnership loses money. Your distributive share is only taxed if there is a profit. Section 4. How to set up guaranteed payments in your partnership agreement. Now that you know what guaranteed payments are and how they are taxed, let's talk about how to set them up the right way, so you avoid costly mistakes and keep your partnership running smoothly. Step 1. Define the terms clearly. Your partnership agreement should spell out exactly which partners receive guaranteed payments, the amount and frequency of payments, monthly, quarterly, and annually, what the payments are for, services, capital invested, or both. Step 2. Align with profit sharing. Guaranteed payments are different from profit distributions. Make sure your agreement explains how profits and losses will be divided after guaranteed payments are made. Step 3. Build in flexibility. Consider adding a provision for periodic reviews of guaranteed payments. This allows you to adjust amounts as roles, responsibilities, or business performance. Step 4. Address tax implications. Remember, guaranteed payments are deductible by the partnership and taxable as ordinary income for the partner. Section 5. Common mistakes and IRS audit triggers. Here are 3 mistakes we see all the time. Not reporting guaranteed payments as self-employment income. 1. The IRS expects you to pay self-employment tax on these payments, even if you are a limited partner. 2. Misclassifying payments. Some partnerships try to disguise guaranteed payments as distributions to avoid payroll taxes. That is audit bait. 3. Forgetting the deduction. Partnerships sometimes forget to deduct guaranteed payments, overpaying taxes. Pro tip, always review your partnership agreement and K-1. If you see Box 4 filled in, that is a guaranteed payment. Make sure it is reported correctly on your tax return. Section 6. Planning opportunities. Curious how top entrepreneurs turn guaranteed payments into a win-win for their business and their bottom line? Here are some smart planning opportunities you shouldn't overlook. Structuring compensation. Use guaranteed payments for active partners who provide ongoing services. Balancing tax impact. Remember, guaranteed payments are taxed at higher rates than passive profit shares. Consider mixing both for optimal tax results. Documentation. Keep clear records in your partnership agreement and minutes, especially if you are audited. With the right planning and documentation, you can turn guaranteed payments into a powerful tool for both compensation and tax efficiency. Section 7. How to document and report guaranteed payments for IRS compliance. Let's talk about something most partners overlook until it is too late: documentation and reporting. Even if you understand how guaranteed payments are taxed, missing a step here can trigger IRS scrutiny, penalties, or lost deductions. Why documentation matters? The IRS requires clear, written evidence of guaranteed payment arrangements. That means your partnership agreement should spell out which partners receive guaranteed payments, the amount and payment schedule, the reason for the payment, whether it is for services, capital, or both. Keep digital records of all payments made, including bank transfers, memos, and meeting minutes approving the arrangement. Audit-proofing your partnership. During an IRS audit, agents will ask for. If you cannot provide these, the IRS may reclassify payments, disallow deductions, or impose penalties. Pro tips for staying compliant. 1. Update your partnership agreement annually to reflect any changes in guaranteed payments. 2. Use accounting software to track payments and flag them as guaranteed payments for easy reporting. 3. If you are not sure, work with a tax professional to review your documentation before tax season. Remember, the best tax strategy is worthless if you cannot prove it. Solid documentation and accurate reporting are your shield against IRS issues and your ticket to keeping more of what you earn. Guaranteed payments are a powerful tool for partnerships. At GavTax Advisory Services, we help partners and business owners structure compensation in a smart and legal way. Book a free 15-minute consultation at gavtax.com. Like, subscribe, and hit the bell icon for more real-world tax strategies. See you in the next video.